Welcome to the Point Podcast. We have informed, intelligent conversations about today's financial topics submitted by viewers like you. Let's go ahead and get started. Here are your hosts, Landis, Wiley, and Alan Wallace.
Hello, and welcome to today's episode of The Point, sponsored by Basepoint Wealth. I'm your host, Landis Wiley, sitting here, as always, with the illustrious Alan Wallace.
Another promotion. Hi.
So for those who don't know, Alan Wallace, Chief Investment Officer, Basepoint Wealth. We're excited to be here. It's the holiday season. Hope everybody had a happy Thanksgiving, Merry Christmas, Happy New Year, all the things coming up. Lots going on. So busy holiday season. Mm-hmm. Busy time in market news.
Right.
Big thing that's been going on in recent weeks, a little bit of a crypto crash. So we always like to kick this thing off by talking about a big headline out there, right? So Bitcoin down almost 25% in the last few weeks. Is it time to buy?
Well, that would mean that I have a crystal ball, right? Because there's no way to predict what Bitcoin should be worth at any given moment. So I would say that there's never really a time to buy unless your sole goal is speculation. And I know there are people out there that feel like, that's a little bit of sacrilege in this modern environment. But the basic fact about Bitcoin is it doesn't generate any cash flow. And so there's never going to be a point where, just because it's down 25%, that means it's a better deal than it was 25% ago, because there's no measuring stick to measure it against, right? It's just what is someone else willing to pay for it at any given time? And so, that doesn't mean I think it's going to zero. I think that it's just as logically inaccurate to say it's going to zero as it is to say it's going to 1 million, because the simple fact is we don't know. We have no idea. It's completely based on supply and demand and basically faith. Mm-hmm. So no, it's not time to buy. Probably never will be. But we remain humble, and we'll keep buying things that generate cash flow.
Mm-hmm. Do you have any concern over the wild swings of volatility around Bitcoin?
Yeah, I mean, there are definitely times where that stuff can become contagious, especially when large amounts of debt are being used to fund purchases. I mean and that's why we follow it at all. Mm-hmm. It's not acceptable to just stick our heads in the sand and ignore it like it doesn't exist. I mean, it's a $1 trillion+ asset class now. So there's a lot of money out there. There's a lot of debt funding it. And that, when those debts start going unpaid, that can cascade itself throughout the financial system. The other thing that's really important to us is how much energy it uses. Now, there are people that say Bitcoin is powered by energy. That's true. But really all it is a receipt for wasted energy. So the value is gone already. The oil or the coal or the uranium has been spent. A receipt has been generated and left behind a code, and that's what people are trading back and forth. So the issue with that is that it's not inert. It drains energy from the system. It's also a sort of a self-contained asset class that has a drain in it because it's leaking energy, it's leaking value. If you look at a corporation, they're constantly interacting with the money supply. Mm-hmm. They're selling things, they're paying expenses, they're continuously cycling cash throughout. Bitcoin doesn't do that. It's sort of inert, with the exception of its leaking value out in the form of energy burn. So I think that we need to pay attention to that, because with the AI data center demand for energy, mm-hmm. we're now plugging our cars into the same energy grid, and you've got Bitcoin, which costs something like the same as 500,000 credit card transactions to process one transaction. Highly energy inefficient. At some point, it'll be the power grid that that is the corrective mechanism here. Mm-hmm. And so as we push that to its limits, we'll see what happens.
So it's one of those topics. It's super important, but maybe not necessarily in the way that people might think, which is, hey, there's a lot of volatility, is now the good time to buy. It may be more, it's a really important headline to follow because it may have a lot of impacts in ways that people aren't necessarily thinking about.
Yeah, and those would be in contagion from leverage. Those would be in, the fact that a lot of young people are losing a lot of money. So that can actually curtail spending. and also in the way that we're draining our energy grid, not just from Bitcoin, but also from artificial intelligence, and then also from electric vehicles. So all those things lead me to say we still need to study it, even if we don't buy it. I'd like to think if I was alive in 1635, I'd be studying tulips, even if I didn't buy them.
Right. All right. So headline, important topic. I'm sure it's going to pop up more than once.
Yeah, exactly.
Perfect. All right. Well, before we get into our main topic of today's episode, we'll take a short break here for a word from our sponsor.
The serene sound of a line casting into the water and the thrill of reeling in a fish. Your retirement could be filled with peaceful mornings on the lake and the joy of the perfect catch. At Basepoint Wealth, we help you plan for a retirement that's as relaxing or adventurous as you desire. Ready to cast your line? Visit basepointwealth.com to schedule your initial consultation with one of our Basepoint Wealth advisors today, because from here, you can go anywhere. Basepoint Wealth is a registered investment advisor. Visit basepointwealth.com for important disclosures.
All right. Well, welcome back to today's episode of The Point. Again, sitting here with Alan Wallace. I'm Landis Wiley. Going to put in a shameless plug here, Alan. So we have started something. I guess now we will have done it twice. So that makes it annual.
Yeah, we're trying to get a little more regular.
A little more regular. So we've got our year-end review webinar.
Right.
That's going to be coming up here before too long. I mean, can you believe it? It's already December?
It's December, yeah.
Crazy. So stay tuned for that. Clients of Basepoint, you're going to be getting some email information letting you know when that's coming out. And it'll be posted up on all of our social media and web presence. So stay tuned.
Sounds like fun.
Should be fun.
Yeah.
So awesome. Well, without further ado, let's dive into the topic today, which is pretty simple and straight to the point, I guess. When's the market going to crash, Alan?
Well, so, if I had a crystal ball, that would be the one time where I'd give myself permission to go gamble in Vegas, right? But I don't. So I don't know. I mean, nobody knows. But we can definitely look at the circumstances and see whether it's likely or unlikely. Mm-hmm. And for some viewers know this, but many may not, that I started my investing career in April of 2000, which
perfect timing.
Yeah. Right. So I walk onto the scene with my brand new Series 7 license. And the NASDAQ is at an all-time high. Mm-hmm. And it took almost 12 years for it to recover that level. Mm-hmm. So I have a little bit of experience with investing when the market is overvalued. Now, back then, I was 24 years old, didn't really know what I was looking at. But even back then, I was very curious and observant. So I watched a lot of things happen. And there are a lot of similarities today to that same period of time. So, I mean, I think we can definitely go down the path of talking about what things are sort of creating danger. Mm-hmm. The problem with valuation is that valuation doesn't cause an explosion. It's like dynamite. It needs a fuse, right? And like a fuse in real life, the fuses are small, but they create the right environment to cause that valuation dynamite to blow up. So the issue is that they're really hard. There's a lot of them. We don't know which one's going to get lit first, and they're very hard to predict in advance. Right. So we can kind of walk down that path a little bit and see sort of where we stand today.
Right. So it's interesting you bring up the 2000 timeline.
Sure.
Because I think more and more we're starting to see news articles and conversation pieces on, the nightly news and what have you that are comparing the AI bubble with the .com bubble, right? And if for those that were around back in the late 90s, there are some similarities, right? You had a multi-year period where the stock markets just seemed like they would never go down again. Mm-hmm. You had very, very large companies breaking records for most valuable company in the world.
Right.
You had companies that were literally adding .com onto the end of random company names to sort of latch on to the mania around the internet, right? And today, it's not .com, it's not the internet. The internet has indeed taken over. It is, it is infiltrated every aspect of life like people said it would in 1999. But today it's really about AI. Right. And artificial intelligence and all of the things that sort of go along with that. So there's a lot of parallels, right, to sort of the headlines that are driving some of this and the mania that are driving this. You mentioned valuation because one of the things that has been talked about and we've talked about previously is particularly some of these AI companies where you have these exceedingly large valuations.
Right.
So NVIDIA just crossed over, I think, 5 trillion in market cap.
I think it's back below that now, but it was over 5 trillion.
Right. So 5 trillion, right? I was reading something, if you go back to one of the stars of the dot-com bubble, Cisco, inflation adjusted, it was valued at like 555 billion, right? So we're 10 times that when we talk about valuation. And that leads itself to market concentration. Right. So you've talked on prior episodes about how the Mag 7 or the big tech, whatever you want to call it, how they make up a large share of the S&P 500.
I read the other day it's 45% now.
45, wow.
I didn't verify that, but that's what the article said. So.
Unbelievable. Yeah. Well, and if you parallel that back to the S&P and the dot-com bubble, I think it capped out at like 25% at that time. So, as you look at sort of these parallels, let's start with market concentration. I mean, what do you tell an investor right now as they're looking at this market and they're concerned about this bubble and asking the question, when's it all going to blow up? I mean, what do you tell somebody about that? What should they be looking at?
I think the danger is that indexing and passive investing have become very, very popular. And whenever you run into a strategy where you don't have to think, where you can just do, where everyone can just do something and they're guaranteed that it'll turn out okay, you have a problem, right? Indexes are not endowed by any sort of divine, magic to always make money. It's just a portfolio of securities selected by a board, right? And so what you need to do is look at that portfolio and see, is this where I would want my money to be? And we look at the price to sales ratio. If you look at the price to earnings ratio, if you look at the concentration, I would tell the average investor this probably isn't a great entry point or even a great holding point. The problem that we have is hindsight bias. People stand at the top of the peak and they look back and say, yeah, but the market has done 11% since 1929 or whatever the number is. But if you go back to my first day on the job in April of 2000, the S&P is up 8% a year, including dividends. So the starting point of your projection is really the most important thing. Only, secondarily is your ending point of the projection, right? And whenever you're at a peak or at the top of a bubble, when you look back, it looks like, oh yeah, nothing else is needed. I can still remember a guy in 2000 standing up at a large conference and saying, why would anyone ever buy anything other than large cap growth? It's outperformed for the last 75 years. Nothing can touch it. Look at the history. It took 13 years for that guy's thesis, to be back to reasonable. So, I mean, we have to be really careful about looking in the past and saying, okay, well, the S&P has always done well. So I think the point is you should know what you own, and you should buy securities that are becoming more valuable based on the company, not based on the stock price fluctuations, right? And so people say, well, yeah, but AI is going to change the world. Sure, it probably will.
They said that about the internet too.
Which they were right. But it incinerated a lot of capital. And that's actually common throughout history with large technological innovations. Look at the canals in England or the railroads in the United States or the radio bubble or the automobile bubble and the dot-com bubble. Just because a big economic transformation comes along doesn't mean that investors are going to make money. Warren Buffett once said that if airline investors would have been at Kitty Hawk with Orville and Wilbur, they should have shot them down, right? That's how much capital has been incinerated by the airline industry. It doesn't mean that it didn't cause societal progress or it didn't cause benefits to the consumer, but it was a terrible investment.
Right.
And I think at these valuations, where people feel like they can just throw money at it, it will be tough to make money. It'll be tough for the AI boom to satisfy people's expectations.
Well, and you talk about how industries have blown up a lot of capital over time. Being able to, pick something that technologically is going to change the world may or may not prove out, right? I mean, maybe AI is the next version of the internet and it will be everywhere in 20 years. We don't know. But even as an investor, if you are able to pick the right winner, sometimes the valuations really still matter, right? So if you and we've talked about the example of Cisco, right? We've talked about it in prior episodes. It's prescient today, and we're seeing more and more articles that are comparing NVIDIA and Cisco, and there's a reason for that.
Right.
Like you said, the internet in 1999 was going to change the world. It was going to be everywhere. Well,
And Cisco sold the equipment that it ran on.
Cisco sold the equipment, and so people's view was the lofty valuations, the lofty price point of Cisco in 1999 was justified because Cisco is going to dominate the network infrastructure space now and forever.
Which
right?
they did.
And they did. And they do. Right?
Right.
But yet a person who owned Cisco in 1999 and rode the 85 or 90% decline in its share price in 2000 2001 didn't get their investment principal back until, a year or two ago?
I think it still hasn't made its money back, even including dividends.
Okay.
So that's 25 years of basically no share price appreciation. Mm-hmm. So it's not enough to just say this is a good company or it's a dominating company. It has to also be bought at a reasonable price that generates returns on capital. And if you look at the turning point of Cisco, the two major things that you saw at the very end in third quarter of 1999 were rising inventories and rising accounts receivable. Mm-hmm. Well, if you look at the most recent NVIDIA income statement, balance sheet, you'll see the exact same thing. Rising accounts receivable, rising inventories. Well, it was so noticeable that NVIDIA actually sent a letter to stock analysts trying to explain it, right? And one of the things that they said was, this is because we're trying to ramp up for our new release. But if you look, raw materials inventory is only up like 23%, whereas work in process is up 157%. So that doesn't look like a ramp up to me. That looks like a slowdown. Now, we won't know anything for another quarter or two, but that early sign of cracking, at least preliminarily, is starting to show. Right. Maybe it won't continue, and that's okay. But if you see 2 or 3 more quarters of that, then you definitely, if a bell was rung at the top, that's what it would sound like. But it still remains to be seen. And if NVIDIA starts to crack, then that basically takes the entire market with it.
Right. So you mentioned, similarities between those two companies, accounts receivable, inventory. One of the other topics that's been talked about a bit, and I've seen it in some headlines, and I'm sure people have heard it and maybe not understood it. But another thing that's very comparable between NVIDIA and Cisco is this concept of vendor financing.
Yeah.
Right. And NVIDIA is not the only one doing this, right? We're seeing this among a lot of these large AI companies in today's markets. What is vendor financing? How does it work? And some of the charts I've seen of how this is structured between these companies, I mean, it looks like a spider's web. So talk about that a little bit.
There's capital funding going on right there too, where you're giving capital to one of your customers, and then they're using that to buy your product. But really, the vendor financing thing comes into what's called channel stuffing, and that is your sales are starting to slow, so you start basically stuffing product into the channel, and so you have what's called days sales outstanding. And that figure is used to determine whether your increase in accounts receivable is starting to become a problem. The problem, and actually Cisco was the case study in this. I am absolutely not saying this is going on because I have no proof of it. But what you'll start to see, you'll see people say, days sales outstanding is flat. So that means that there's no channel stuffing going on. But that can take up to 3 quarters to show because they start doing things like extending credit terms, right? So you're at 45 days, you have to pay. Well, let's extend that out to 90 days. Or you start to book the revenue differently based on when you ship it, right? There are 8 or 9 little tricks you can use to sort of keep your days sales outstanding flat while your accounts receivable start to sort of blow up. And I think that's the biggest issue there, right? Is where you start to become a creditor to your customers because they don't have the money or the need for the product. You're basically stuffing it into the channel. Right. And so now, you're selling credit instead of selling product. No evidence that that's happening yet, but the first sign you would see would be a big blowout in accounts receivable.
Right. So something to watch.
Absolutely.
Right?
Yeah.
Because definitely starting to hear more about that.
Right.
Sort of in today's world. So, so as you look at this and, we can talk about individual companies or, sector comparisons, that late 90s mania to the AI bubble today. Obviously, it all blew up, right? It blew up in 2000, 2001. The NASDAQ took a dozen years to recover, right?
That was the S&P that took a dozen years.
S&P.
Yeah.
So when does it happen now? right? Because this has sort of been the thing hanging over the market's head for over a year, right? Of people saying there's a bubble, it's going to blow up. And yet the markets are up, a good amount in 2025.
Yeah.
So when does it happen? And what are the things that you're looking at? And what would you tell an investor who's getting nervous and saying, do I need to be on the sideline for this?
Well, first and foremost, I would say you never want to be on the sideline. So we're lower than we would normally be in equity allocation, but we're still 50%. It's just the equities that we own are reasonably priced based on the income that they produce, right? We still have some fixed income. We have very low credit quality, very low credit risk. We've got cash. We've got gold and silver. We have just a very tiny little bit of real estate. And so you have to have your allocation built in a way that, you're not trying to predict the future. So it's not about predicting a recession or predicting a market crash, because for all we know, there could be deflation. And if you're, positioned 100% for inflation and you have deflation, you're going to get wiped out even though you're trying to be careful, right? So it's really about making your portfolio a balanced whole. We have treasuries in case there's deflation. We have equities and gold and treasury inflation protected securities in case there's inflation. We have certain investments in case there's a recession. We have equities that'll do well if the economy continues to expand. The problem runs into when someone is focused in all this AI stuff and they're doing 20% a year and they look at our 8% and say, hey, I'd rather have the 20%, right? The problem is that 20% is not based on anything becoming more valuable. It's just based on, the sort of greater fool theory that someone else is willing to pay you more for something that, has remained the same value.
Yeah. Well, and you've talked in the past, for the average person out there, they don't need to shoot for 20% in a year.
Right. Yeah, we calculate how much people need in order to make sure their money lasts the rest of their life.
Right.
And it's not to say that we're not trying to get high returns. We are, but we're trying to do it in a way that minimizes the loss. Losses are much more damaging to your returns over time than gains are beneficial. Right. If you lose 50%, you need 100% return in order to break even. If you lose 75%, you need 400% return to break even. So it's really hard to make up for that.
So what are the things that you're looking at as far as, metrics or data points or headlines that give you the most pause, if you will, in today's market?
Well, first and foremost is credit risk, right? Because if you think about all the assets out there, there's 120 something trillion dollars in financial assets out there in the United States, and there's 22 trillion in cash, right? So, in order to convert an asset into another asset or to convert an asset into a purchase of goods, you have to run through that monetary channel, right? And so you have to ask yourself, is there enough cash to support the asset balance sheet? And so there's been 3 times in history where the stock market has been 3 times the amount of cash available. You want any guesses on what years those were?
I'm going to guess they correspond with big market crashes.
Yeah, well,
so let's go 1929.
That's number 1, yeah.
99.
Yeah.
2000.
And this year, right? Sure. So here's the issue with that.
Hey, by the way, that was pretty good.
Yeah, no, it was. Yeah, it was great. It was great. The issue is that in order to keep the market propped up, the Fed's going to have to inject more money into the system. But we're already at the point where we're having goods inflation. And so if we continue to print more money in order to save the market, we're basically going to transmit some of that leakage from the asset markets over into the goods market. And what happens then is average people can't afford to eat, they can't afford the rent. And we're already at that point where people are screaming, we can't buy houses, we can't afford education, we can't afford healthcare, we can't afford food. So there's very little tolerance for pumping more money into the system. And so if the money supply starts to drop either through interest rate policy or the Fed liquidating part of their balance sheet, then you're gonna see people start to rise up, right? And so the Fed is sort of trying to ride that line between not creating too much inflation and not crashing asset markets. But the majority of the people in the United States right now don't own assets. I mean, you'll always see these figures like the the top 10% own, X percentage of all the assets. And basically monetary policy has propped up the price of those assets, especially those, multi-trillion-dollar companies that, are the majority of the S&P 500.
Right. So where do we go from here?
Well, we continue to be careful. Mm-hmm. We keep our eye on credit risk. We monitor economic policy. If the Fed starts quantitative easing again, we'll probably see the market continue to burn a little bit higher, because that money is going to find its way into risk assets, and it's going to slowly cascade the yield up on those assets, right? That doesn't mean that's going to go on forever, but it tells us that we probably have a little bit more time. Mm-hmm. If there's more government stimulus, there's been talk of, sending checks to people. If you go back and look at history, those checks being sent directly to people are what almost directly creates inflation. Right. So there were 3 COVID stimulus payments, and they correspond almost to the minute to when the goods inflation started. You know, so if you give money to the bottom half of earners, they go out and spend it, and it doesn't increase the amount of goods. The amount of goods are the same, but now there's more money. And if those people aren't going to save that money and put it into asset prices, it causes the price of goods to go up. It's just a math equation, right? Right. So if there's any more government stimulus coming, we're probably going to see more goods inflation. If there's quantitative easing, we're probably going to see more asset inflation. If there's any sort of decline in the money supply, we will probably see an asset price correction. So an asset price correction can really come from 3 or 4 different ways here. It can either come from a recession, right? So let's say that NVIDIA is starting to channel stuff, and there is a backlog of chips out there, or that Google is now going to start selling TPUs instead of GPUs, and they work more efficiently than GPUs, which people are starting to say, right? Or that Google starts winning the AI race, or any one of those things that cause a recession in the AI complex. You could see a big market correction. Private equity and private credit are starting to crack a little bit under the pressure. Now, they're not publicly traded. They don't have public disclosures. So they could probably hide that for quite a long time. But what you're starting to see is what they call PIK, S-P-I-K, payment in kind, in both the business development corporation and the private credit spaces. What that means is that the companies that borrowed money from them don't have cash. So instead of giving them cash, they're just adding to their tab, right? Okay, but the problem is these BDCs, business development companies, have to pay out 90% of all their income, otherwise they become taxable entities. So they have to take a loan in order to pay out what they just received extra liabilities for. You can only do that for so long. Right. So if you start to see some credit losses in the private credit or the BDC space, that can start to spread, and that could cause money to flow out of equities to try to cover those losses, right? You could see some sort of geopolitical turmoil, right? Another war, another terrorist attack, any one of those sort of things could also cause people to start to prefer holding cash to holding assets. Or you could see inflation. And so if inflation starts to pick up, people have to use more of their assets in order to pay for goods. That causes assets to start to drain. And again, all the assets have to pass through that monetary channel in order to be converted into goods. So if you look at, I cited that, this is only the 3rd time that the stock market itself has been 3 times the money supply. Money supply is about 22 trillion-ish. But NVIDIA right now is like 25% of the money supply, that one company. So if everyone that owns NVIDIA decided tomorrow that they prefer cash over NVIDIA, it would take 25% of all the money out there in order to do that.
Seems problematic.
It does. Basically, your exit is small in comparison to the amount of assets. Those aren't things that happen directly, but if they're ever, if you go back and read John Maynard Keynes, it's called liquidity preference. And if people prefer to hold cash, which is current consumption, in replacement of future claims on cash, then you have to have enough cash to get through the door. Right. And it doesn't appear that we're in that position right now.
Okay. So that's a lot of things.
It is. Right.
A lot of things potentially, sort of putting pressure from the outside in on this. I don't think anybody can say it's not a bubble. right? At this point, I mean,
The thing about a bubble is you don't know until it pops.
right. Yeah.
Because you're inside of it, right? And it's really hard to see the walls of something that you're inside of.
Right.
Or I'm sorry, see the boundaries of something that you're inside of. But what I can say is that I'm very comfortable with the way that we're positioned, that we can ride out a storm. It doesn't mean that we won't have fluctuations. We definitely will have fluctuations. When the market goes down, it takes everything down with it. But when you have companies that are priced reasonably in relation to the amount of cash that they generate, they recover a lot faster than when you own Cisco at 100 times earnings and it takes you 25 years to get your money back.
Right.
And so, and again, this is not a prediction. I have no crystal ball, but what I can tell you is that throughout history, if you look at 2000, if you look at 1972, if you look at 1929, these similar type of circumstances were in place, and we know what happened then. I can't point out a historical analog where things were like this and everything just went up forever.
Right.
Okay. So that just tells me that the probability is probably on the side of some sort of correction occurring. When? We don't know.
Right. Yeah, and I think that's kind of the key takeaway here, right? Is we can look at all of these factors and say, well, it's never done this before.
Right.
And maybe this is the time that it's different.
Right.
Right. Fact is, we don't know. Right. And nobody does.
Right.
And so trying to place outsized bets either direction, kind of a fool's errand, right?
Well, especially when we know if we just do things a certain way, we can get the return that you need. And that when things have been like this in the past, you've usually had a really awesome opportunity sometime over the next year or two to really increase your future returns, right? Because when you look at, so if you look at the, I quoted that 8% return since I started in the business. The reason that it's only 8% is because you lost half your money 6 months later. Right. If I would have started 3 years later, the return would have been almost 12% because you would have missed that decline. Yep. And so that's why I'm saying be patient, being patient to wait for better prices so that we can increase the next 20 years returns. Right. That's a 25-year time period. And by waiting 3 years, you could have increased your return by almost 50%. Right. Just by being patient. Right. So the downside is we just make the return that you need to make sure your money lasts. The upside is we get a 50% increase in returns for the next 25 years. Right. That's not a close comparison to me, because I know you're going to have enough money, but you may have a significant, larger amount if you're just a little bit patient. But when the market's screaming higher and the neighbors are getting rich, it's really hard to look away. Right. And that's what we really have to deal with here is fear of missing out. Mm-hmm.
Yeah. Well, I think, in a lot of our conversations, it really boils back to patience and discipline, right? And not getting sucked into the headlines, not getting sucked into the noise, fall back on things to be real, make logical plays, right? Yeah. Make, take out positions in companies that are reasonably priced. Right. Don't chase the thing that's screamed higher the last 3 years just because you see it on the news and
Well, people have a tendency to think that past returns or coupons that are going to repeat themselves. The higher the past return was, the less likely that return is to continue. Right. And I think it was Tolstoy that said that the two most powerful warriors are patience and time. Right. And not that we like to copy Buffett, but if you take a look at what he's doing, he's sitting on $400 billion in cash. Right. And so that lets you know that at least at his scale, he can't find anything worth buying. Mm-hmm. And that's not a reason for us to do anything differently than what we're doing. But it lets you know that, we're not on an island here. We are seeing the same things that other people are seeing.
Right. Perfect. Well, I think that's probably a good place to kind of wrap this up.
All right. So sounds good.
I'm sure we'll be checking back in on this topic in a couple of months.
These things always run on longer than you hope they would.
Yeah. Well, one of these days we're going to have the conversation and be like, oh, it happened.
Yeah. Right.
So maybe we'll still be in the profession by that point.
We'll see.
So we'll see. But awesome. Well, great conversation.
Yep.
And thank you for tuning in today. And, as always, if there's a topic that you're hearing about, reading about, bantering about with friends or, people at the coffee machine, you want to hear us banter about it here, send us in a question. We'd be happy to toss it in that proverbial hat and see what we get to chat about. So again, stay tuned for the upcoming year in review webinar. It's going to be coming out soon. And until next time, check us out online, YouTube, Vimeo, basepointwealth.com, Facebook, all the places. We're everywhere these days. So with that, happy holidays, and we'll see you next time.
Thank you.
Thank you for joining us for this episode of the Point Podcast. sponsored by Basepoint Wealth. As always, you can submit questions or topics you'd like to hear discussed to info@basepointwealth.com. Be sure to subscribe so you don't miss any future episodes. Basepoint Wealth LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.